Okay, welcome to episode 4 on the put path. We're going to go over how to choose delta and probability of profit. So, if you could open up your Robinhood app and go to your investing tab, go to QQQ, click on that, click on trade, trade options. We're going to go out to our normal 28 days, which is approximately October 31st. And then we want to be selling the put. Now, just a little bit of background before we get into it. The probability of profit is the probability that your option is going to make you money. Typically, we're either going to have 100% profit or 200% loss, a 2x loss. So those are the primary outcomes with this system. Sometimes we'll have some in between where you make a little bit of money or you lose a little bit, but those are more rare. So since we have an 85% chance of winning the trade, we're in a highly powerful position. With TastyTrade, you can look around the one standard deviation trade, and that's approximately minus 0.15 delta. With Robinhood that we're looking at right now, you can easily see the probability of profit, which is what they call the chance of profit. And then with Fidelity, you can also look at the delta as a minus 15. So one of the basic trading concepts I wanted to go over with you is the difference between intrinsic value and extrinsic value. So intrinsic value is going to be the difference between the option strike price and the underlying assets price. Now, all of the assets that we trade are going to be out of the money, which means they have no intrinsic value. Another concept that we want to talk about is extrinsic value. So that's the difference between the market price of an option and its intrinsic value. So you add the extrinsic value onto the intrinsic value, and that gives you the total value. Another thing that we want to go over is the concept of moneyness. So moneyness means, um, is it in the money? Is it out of the money? Is it at the money? So for our examples, we are going to be trading out of the money options. So an example would be if you have a call option for Tesla at 100 and the stock price is currently at 109, then you would have $9 of intrinsic value. So those options would be in the money. So if you were to exercise that option, you would own the stock at 100. You could sell that underlying stock for 109 and make $9 profit. So that $9 would be the intrinsic value of the option. So $900 would be the total value because you have $9 profit per share, 100 shares, so $900 profit. So again, that is intrinsic value. So for extrinsic value, that's the value set largely by the market. So the market looks at the time to maturity and the volatility of the asset to figure out what the extrinsic value would be. The more volatile the asset is, the more extrinsic value. The more time to maturity, the more extrinsic value. So basically, time to maturity is defined as the time left open in days until the option contract expires. The volatility is the market perception and is the largest variable in the Black-Scholes model. It's the variable that you solve for in the Black-Scholes equation because all other values are known. So with all of that being said, let's take an example here. What we typically would do for our QQQ, which is our primary trading vehicle, it's the one that I recommend that you start with. You can see the share price here is at 603 with and 7 cents. So we're going to scroll down, and you can see chance of profit there in the second column. Scroll down to chance of profit at 85. Okay, so I'm going to pause here. So there's a few different options. There's a few different ways that you can kind of think through these decisions. Sometimes we may go down to 84. Sometimes we may go up to 86, but the range that we're looking at starts at 85. So depending on the pricing, this is obviously very definitive pricing. You only have one um, dollar increment between the prices. Sometimes you have five. On some of the other things that we trade, you might, for example, it would go from 565 to 560, from 565 to 570, and you don't have the dollar increments, which is not advantageous. With QQQ, it's very liquid, very tradable, and it does have the dollar increments, which is awesome. So in this case, what we would do is select 567, chance of profit 85.23. So when you're selling the put, you click on the plus, okay? And then you would buy the put, okay? And you would go down 5 wide. So you're going to buy the 562. You're going to open that as protection, hit continue. And now you can see the mid price is at 48, which is excellent. So you're opening up a spread, okay? And you can see at the bottom there, it tells you a summary of the spread that you're opening. So you're opening up the 567 on October 31st. You're going to sell that one to open. And then you're going to open up the 562 put, 1031. You're going to buy that to open. You swipe up to submit. And now the order is queued. Now, today the market is not open, but if this were during the market, it would have gone straight to market and most likely executed at mid price. So I want to talk a little bit more about probability of profit for this episode. So these options are all priced on the normal curve. So normal means, at the 50% of the normal curve is going to be your average, it's going to be your mean. The stock price could move above the mean, could move below the mean within our period of performance. So all that we're trying to do is make sure that that stock is above the stock price. So we want, for this example, we want the stock to remain above 567, and it's currently at 603. So that's roughly 5% of a move that it would need to make before October 31st. So as long as it stays above that, we'd be great. If it stays at 603, the trade's a winner. If it goes down to 567, the trade's a winner. Obviously, anything above 603, the trade's a winner. So you have all of that chance for probability of profit. So how did 85% kind of become that optimal range? Well, when I started trading after I lost a lot of money the first 2 years, I started trading overly conservative because I was trying not to lose money. So I started going at 2 standard deviations, which is 95% probability of profit. Now, that is great. I won a lot of trades. However, the problem was I wasn't making enough money on those trades. So I was only getting about 20%, maybe 25% of the premium that I'm getting now. So on that trade, you can see we had 47, which is basically $47. So I was getting maybe 13 cents, $13 on that trade. So you can do that, but it's very challenging because you're not going to be able to make enough money. So you have a higher probability of profit, you're winning a lot of trades, but then you're not making a lot of money. So I tweaked it. I looked at, can I go up to 65%, maybe 50%? So 50% is roughly around at the money, meaning you're going to trade the credit spread with around 603 or so as your sell price. So in that case, I you're obviously getting riskier the closer that you get to at the money, and your profitability starts to decline in aggregate. So there was a lot of different, price points that I looked at, a lot of different percentages, probabilities, profits that I looked at, and basically had an Excel sheet with some modeling and some advanced mathematical calculations, and we came up with 85% being calculated to be the sweet spot. I've stuck to that for years. Again, tried to tweak it a little bit higher and lower, but the 85% works best in the aggregate to give you your best profitability. That is it, and we will continue down the put path in the next episode.